All right, let's dive in. Today, we're talking about something absolutely critical for any investor, hedging. In a market that can feel pretty wild sometimes, knowing how to protect your portfolio, well, it's not just a nice to have, it's essential. So let's get into it. So let me just ask you straight up, is your portfolio actually crash-proof? It's a question that, probably keeps a lot of us up at night, especially when the market feels a little shaky. That fear of losing all your hard-earned gains is real. But thankfully, there are some pretty powerful strategies to help manage that risk.
And look, this question is a really big deal right now, and here's why. A lot of portfolios are super concentrated in just a handful of huge tech stocks. Now that's been amazing for returns, for sure. But it also creates this really dangerous single point of failure. If those few giants take a hit, your whole portfolio could go down with them. Learning to hedge is how you build that safety net.
Okay, so here's our game plan. We're going to walk through 5 key areas. We'll start with what hedging really is. Then we'll cover some simple and more advanced ways to protect your stocks. We'll even see how this stuff applies to crypto. And finally, we'll get down to the bottom line. What does all this protection actually cost?
First things first, let's build a really solid foundation and get the why behind hedging. Seriously, just think of it as the insurance policy for your portfolio.
So, what is hedging, really? Well, the textbook definition says it's a strategy to offset potential losses by taking an opposing position. Let's make that simpler. Imagine you're betting on your favorite team to win. A hedge would be like placing a small, separate bet on the other team. That way, if your main bet doesn't pan out, you don't lose everything.
Honestly, the best way to get it is to just think of it like insurance. You pay a small fee, a premium, right? Not because you think your house is going to burn down, but so you're covered if the absolute worst happens. It is the exact same idea with your investments. Now, this is maybe the most important thing to get straight about hedging. A hedge is not designed to make you a bunch of money. Its job is to be a financial shock absorber. The goal is just to lose less money when things go south, so your main investments can bounce back that much faster. So remember this, a hedge is for protection, not for profit.
Okay, with that in mind, let's get into some practical tools. We'll start with the most straightforward ways you can start protecting your stock portfolio.
We're going to look at 3 pretty straightforward strategies. First up is good old-fashioned diversification, sometimes called a barbell approach. Second is a specific kind of financial tool called an inverse ETF. And third, and this one's more for the experienced folks out there, is short selling.
So what you're seeing here is a really key difference in how you can approach this. It's kind of like a structural versus a direct hedge. On the left, diversification is what we'd call a structural hedge. You hold things like gold or bonds that historically just don't move in the same direction as stocks. It's a broad, long-term thing for stability. On the right, an inverse ETF is a direct hedge. It is a specific tool built to go up when the market goes down. That makes it a much more targeted, short-term play.
Okay, so once you get the hang of the basics, you can graduate to some more advanced tools that give you just incredible control. Let's talk about stock options.
Options let you be surgically precise. A protective put, which is just the right to sell a stock at a preset price, is like a direct insurance policy on that one stock. Then you've got a VIX hedge, which is totally different. The VIX is basically the market's fear gauge, so you're not betting against a stock, you're betting that overall market panic is going to spike. And finally, there's the collar, which is a really slick strategy that uses 2 different options to protect your gains, often for very little cost.
All right, let's zoom in on the collar, because this is a really clever one. First, you buy a put option, and that sets your floor, a guaranteed minimum selling price for your stock. But that costs money. So, to pay for it, you sell a call option, and that creates a ceiling. That just means you agree to sell your stock if it goes above a certain price. Here's the magic. The money you make from selling that ceiling often pays for your floor, making your downside protection basically free. The catch? You're giving up some of your potential upside.
This table does a great job of laying out all the trade-offs. You can really see the relationship between how complicated something is and how much it costs. On the simple, low-cost end, you've got gold and bonds for general stability. Then in the middle, inverse ETFs, still pretty easy to use, cost a bit more, but they give you direct protection from a market drop. And then over on the right, you see options like puts and callers give you the most precision, but they're more complex and, well, puts can cost you. There's no one-size-fits-all answer here. It's all about picking the right tool for the job. So, that's stocks. But what about the wild west of crypto? The same ideas about managing risk totally apply, but as you might guess, the tools are a little bit different.
Okay, let's look at 2 crypto-native methods. On the left, we have the delta-neutral hedge. It sounds complex, but here's a simple version. For every Bitcoin you own, you place an equal-sized bet that Bitcoin will go down using something called a futures contract. This balances everything out. If Bitcoin's price drops, what you lose on your coin, you gain on your bet, locking in its current dollar value. On the right is an even simpler idea. You can deposit your Bitcoin and borrow stablecoins, which are crypto tokens designed to always be worth $1. You've basically just swapped your volatile Bitcoin for stable cash, but without actually selling and having to pay taxes.
Now, check out this table. You can really see the unique risks in crypto. A perpetual short gives you a perfect one-to-one hedge, but the big one is liquidation. What that means is if the price suddenly spikes up, believe it or not, your whole position can get completely wiped out. Poof. Now look at protective puts. They're better for long-term holders since you can't be liquidated. But the risk there is premium decay, which just means your insurance policy slowly loses its value over time. Every method has a different kind of risk you absolutely need to understand.
This all sounds pretty good, right? But it brings us to the most important practical question of all. How much is this insurance gonna cost me? Let's talk about the price of protection. So, what's a good rule of thumb here? Well, a really solid starting point is to budget somewhere between 1 to 3% of your portfolio's value every year for hedging. Just think of it like your annual insurance premium.
So, how do you think about that budget? Well, if you spend just about 1% a year, that basically buys you disaster insurance. It's designed to protect you from a huge crash like 20% or more. If you're more worried about the smaller dips and bumps, a 2 to 3% budget gives you more active protection. But you got to be careful. Spending over 5%, that's usually too much. The cost of the insurance itself starts to really eat into your long-term growth.
And that right there is the fundamental trade-off. You've got to understand this. Hedging is not free. The cost of those premiums creates what we call drag on your portfolio. In a year where the market just goes straight up, the money you spent on that insurance is basically a loss, and it's going to drag down your overall performance.
But there are some really clever ways to lower those costs. You don't have to insure 100% of your portfolio. Ratio hedging just means you only protect a piece of it, say 30%, and that can slash your costs. Another smart move is using VIX calls, because volatility can go absolutely nuts during a crash. A very small bet on the VIX can create a huge payoff that helps offset your other losses.
At the end of the day, hedging is a really personal choice. It's a balance between how much it costs and how much peace of mind you want. So I'm just going to leave you with this one question to think about. After the next big market drop, what are you going to regret more? The money you lost in the crash, or the small percentage you could have spent to protect yourself? It's something every single investor should think about. Thanks for tuning in.